when we talk about bond, I guess contrary to our conventional wisdom that it's actually a lot big, I wouldn't say a lot, but it's much bigger than equity market when we talk about the total market cap. It's just that because they don't trade on a centralized exchange, most of the fixed income instruments are traded in terms of OTC or the counter market. If you, this is a number that we got off Reuters earlier this year, February 2024. The global bond market stood to the value of total $133 trillion. It's actually bigger than the stock market globally combined. And a very large portion of the market cap in the bond market, belong to government bonds. So you may hear or recall things that you see in the media, where, for example, the US have to keep increasing their debt ceiling. So I think that across many developed or including developing nations, government debt is a very important part of the funding in terms of keeping the public services running. Okay, then we look at it in terms of bond. What is the difference between a bond and debt? Debt is a very common term that when we discuss that as simple as a IOU contract, every type of loan, okay, or debt or obligation of people borrowing money is considered debt. But under this very generic term of debt, when we define something to be called as a bond, that means that such debt had gone through a process of securitization. So you have converted that into a security. And what does that define as a security? That means it becomes negotiable and transferable. Okay, what does that mean? Negotiable means there's a price you can negotiate between buyer and seller. Transferable means that it can easily change the ownership and also even across jurisdictions. Okay, so once you become a security, think about like shares, right? In Australia, someone here sitting here in Sydney, you can buy the securities from different exchange. Same thing as you do bonds. Okay, you can buy bonds that are issued by companies from the States, Hong Kong, UK, right? So, okay, excellent. Thank you. We've got actually people joining online. Excellent. So, so when we look at bond, it's really it's a debt that has gone through the process of securitization. So it becomes a security. Okay, so then you start to hear that the features that are associated with bond, whether they are paying a fixed coupon or floating rate coupon, or whether that the nature of the coupon may change from fixed to float, or whether that you may have a convertible bonds or hybrid, is the seniority of the claim, and also the different issuing entities, whether they're government or supranational, like the World Bank, IMF, Asia Development Bank. Those are the supranational agencies. Then obviously companies and with asset-backed securities such as mortgage-backed or asset-backed, right? So those are the different type of variation and permutation of what can be structured as a bond. They are all called debt, and bond is a subset of debt that had gone through the process of securitization. Okay, so then once you start to learn more about what's when you start dealing or start learning about how to invest or trade bond, then you start to hear some terminologies like trade date and settlement date. They are very commonly used across other asset classes as well. So the reason why we want to mention about trade date and settlement date is that they are also identical to when you trade equities. The liquidity in bonds market is also a T+2. That means if it's trade day today, we consider if you buy or sell something today, we consider today as trade day. And then in 2 business days, that's where you settle. Okay, so whether you're buying a bond, then obviously the settlement will occur in 2 days' time. If you're selling a bond, the money will come back to your settlement account in 2 days' time. It's the same as you trade stocks or equities, right? So it's an extremely liquid market, even in the OTC space. Something we talked about is accrued interest. There's something that's unique to bonds. If you are experienced investors in equities or you invest in managed funds, when you are expecting to receive distributions or dividends, there's a certain ex-dividend day or ex-distribution day, right? That marks as the entitlement of someone if they are on the registry on the date of ex-dividends, then they were entitled to receive that distribution for that period. But if you decided to sell your stocks or your unit in the fund before the ex-div day or ex-distribution day, then you will not be entitled to it. Okay. Now, that is very different to someone investing in bond. Let's just say you have a bond that pays coupon every 6 months. Okay, you received a coupon 3 months ago, but you feel that actually right now you might be able to cash out at a quite good premium, or you probably need the capital to secure a property you really like. So look, I'm not going to sell that bond now. I can't wait for another 3 months for the next coupon payment. And guess what? You will still be entitled to the last 3 months, the period that where you're still holding the bond. Your buyer, your next buyer who buy the bond from you will have to pay what you are entitled to for the last 3 months that you're holding the bond. So that's what we consider something that's accrued. Although that you're not yet paid until the next distribution, but the buyer will pay you for the last 3 months. Think about it like you transact in the investment property. Okay, so in the investment property, right? Let's just say between a vendor and a buyer, you have a tenant in the house. The tenant already prepaid the rent for a month, and the settlement falls in the middle of the month, right? So what happens between the vendor and the buyer? You have to work out that, okay, the first 2 weeks of the month belongs to the vendor, and I have to refund the remaining 2 months of the month and to the buyer, right? Same idea, same concept. So when someone invests in bond, this becomes a very fair, although quite different to other asset classes. So this feature only exists in bonds that where someone, let's say, whether you are in the bond for a week or a month or 3 months, if you close out your position, you sold down your bonds before next distribution day, you are still being paid for the period you're holding that instrument or that security. So it's quite fair to the bond investors. Okay. Then the next concept that where you often hear people talking about whether the bond's trading discount or premium. So we start as a par value. Par means face value. So typically a bond will be issued at a face value of 100 per unit. So when the bond starts trading below that $100, and we consider that as trading discount. Vice versa, when it's trading above 100, we call it something premium. Okay, so just using a very, very basic example, on the right-hand side of the slide, we say that, look, let's say an investor looking to invest in a bond with a face value of $100,000, and then it carries a fixed coupon rate of 6%, okay? But right now it's trading at discount, only $90 per unit. So it means that someone's only have to pay $90,000 for a bond that has $100,000 worth of face value, okay? But the coupon of that 6%, you always work that off the face value, not the price, not the settlement amount you pay. So it means that if you're buying a bond that pays 6% of fixed coupon, that means it's the 6% of the face value, means $6,000 in a year. So when you only pay something that you pick up something in discount with $90,000, but you're still getting $6,000 in as a coupon, so your effective yield is actually higher than 6%. Right. So again, vice versa, if you have to pay more to buy a bond, let's say you have to pay $110,000 to settle a bond with a face value of 100, you are still also getting a fixed coupon of $6,000. So your effective yield is lower, probably about 5.2, 5.3%. Okay, so that I guess what we try to highlight here is that whenever you see the coupon rate, you always work that off the face value, not the actual price you pay. Right. Okay. So the next thing that you would often hear associated when you are looking at fixed income or bond space is about credit rating. Right. So obviously there are quite a number of rating agencies around the world, but the three most prominent ones are the S&P, the Moody's, and Fitch. The way that in terms of some of the scaling or the way they call it AAA, whether it's uppercase or lowercase, they typically mean the same thing. So I think what we're trying to, share with you that it just in a nutshell, when you hear someone saying a bond is investment grade bond, that typically means that they are ranged, triple B minus and above.